Hi, all. I'm waiting for the picture. Picture, come on. 1, 2, 3. See, it came on upon my command. That's how powerful I am. Thank you, Verizon. In any event, Dr. J is somewhat contrite coming to you live, streaming live from Long Island, New York, because the weather was great, but the market stunk. So as great as the weather was today, that's how lousy the stock market was today. And even though that's my call for it to go down through at least the end of the week, I am not happy because I lost tons of money today, as did the average investor. Whether you own mutual funds, individual stocks, dividend paying stocks, utilities, tech stocks, pot stocks, you name it, any kind of stock, you had a bit of a bloodbath today, and your bottom line is not what it was yesterday. So none of us can be too happy. Having said that, the doom and gloomers are coming out of the woodwork. They're now saying no correction. They're saying bear market. They're saying 50% declines. All kinds of numbers are being tossed around. Well, maybe one day that'll happen, but Dr. J doesn't think that's happening just yet. So I will give evidence as to why I do not think that's happening, why my call, I believe, is still very correct, that we end on Friday or Monday or Tuesday, something along those lines, and that we end with a very modest correction, maybe not that modest, anywhere between 12 and 18%, depending on the index that we're looking at. By no means is that nothing, that hurts, but it's better than a 50% correction. It's better than 20% bear market territory with expectations of more to come. So I will explain why, even if it will be a bear market, there's nothing to panic about just yet. If we're in a bear market, we will have time to sell. So I will explain that in the forthcoming video. As always, do your own due diligence. My opinions are my own. I'm not influenced by anybody. I have no insider information, and my opinions do not constitute advice. Seek an investment advisor if you choose to follow me. Occasionally, Dr. J has some good ideas, so you might want to follow me, but at your own risk. Please subscribe to this video, share the link, write comments, like us, please, so that we can continue this, or that I can continue this in good conscience. Getting a little tongue-tied here. I'm going to share screen so I can share my charts and explain visually why I'm saying no bear market. The Verizon delay, I apologize for it. You may not have caught the last couple of sentences that I said. Let me assure you that you didn't miss too much. Okay, so let's look at the NASDAQ, which took the biggest punishment today, right? Well, it wasn't up 2 points. Something's wrong with that. All right, let's fix it. I'll have to let it load and then reload it. That's always fun, considering how quick my computer is. All right, in the meanwhile, we can chat about other things. Well, I guess there's no time to chat about other things when we have the chart. We'll chat about the chart. Another little tongue twister. All right, so I have to refresh this wonderful chart because the NASDAQ was not up 0.03%. It was down 4.63%, and that's why people are panicking. Do not panic on one day's performance, please. Even though, as you can see on the chart, we've given back more than a 61.8% retrace from the, I believe it's April lows. Let me see where we made our lows. April 4th. So from the April 4th lows of 63.26, we shot all the way up to 7,700. And now we've retraced back to 67.89. And before it's all over, we probably will go back to those lows or very close to it. Those lows again are 63.26. So 77 take away 63 is less than a 20% bear market correction. It's probably about 17, 18%, doing the math in my head, which I should never do because when I'm rushing, I'm prone to making errors, but you can check that. I believe it's well short of the 20%, or at least somewhat short of the 20%. So we're not going to enter bear market territory. We have a standard ABC correction. This high is greater than that high, so that rules out a 1, 2, 3, 4, 5 wave down, Elliott wave type bear market. A reversal would have to be an impulse wave of five parts. But this, being that this high is not greater than this high is greater. We only have one wave down, one wave up, and a third wave down that should about be equal to this wave in terms of length, distance, magnitude, and time. So that's why I calculated based on that we will be done with the correction around Friday. And I think it's going to go down probably the full correction to about 63.50, something like that. So let's draw that in. Originally, I was hoping it would stop at the 61.8% line, but it looks like it's going to be a little worse than that. So let's draw that in. So what we expect is something like this. Something like that. Okay, so, approximately. And how long? Friday, maybe Monday. So Dr. J says, no bear market. We start going up after that. Up. You like up? I like up. So I'm sure we're going to go up. I'm not sure, but I'm hopeful that we're going to start going up. I drew an awful doodle. Let's see if I can do a better Yankee Doodle. Yankee Doodle Dandy. I don't know why it got a little squiggly there too. So let's try again on my doodling. Come on. Not that it matters. You understand what I mean. We're going up afterwards. I'm terrible. I can't draw. I'm not even going to try. It's going up. UP. All right, so let's look at the Dow. Do we have a similar chart? I'm sure we do. The Dow also, you can't count 1, 2, 3, 4, 5 for an impulse wave because this high is lower than this high. So the all-time high on the Dow was 10.3, and the all-time high was close to 27,000, 26,951. And if we get the full retrace to the lows of 323, 23.5, then it will still be well shy of 20%. So it's probably about 13%, something like that. So that's a typical correction. And it certainly conforms to the A, B, C that we talked about yesterday. So I'm good with that. The Qs, I think we'll see a similar picture. I even labeled it ABC. I have my C stopping at 61.8%, but I think very likely it'll be a full correction all the way down to 154 by the time we're done. I see another big red candle either tomorrow or Friday before we turn around. On the let's just check the spiders. I think it's pretty much the same story everywhere. We go down to 259 from the high of 293, which is again not close to bear market territory. What can we count? We can count the spiders differently. We can count this as a 1, 2, 3, 4, 5 down. So it is possible to make a case for a bear market for the spiders. But the reason I'm not big on doing that is, one, because I don't want it to be a bear market. And two, I know that's not a very good reason. And two, because you don't see a similar picture in the Qs and the Dow. Why should the spiders go into a bear market, but not the Qs and the Dow? I would think all three indices would. Although Elliott wave purists would argue that one of them has to enter a bear market first and then the others will follow. If you believe that, then you could make the case for a bear market in the S&P 500 index. I don't like it, but I mean, it's possible to argue that as an Elliott waver. You can count 5 waves, which is an impulse wave, and say that we've seen the top, 293.58 or whatever it is, 293.94, could be argued to be the high for the next 5 years or 3 years or whatever, however many years. I really hope that's not the case. The way I look at it, two of the indices are saying ABC correction. One of the indices is saying could be a five wave impulse. And if that's the case, I won't be happy. Let's hope that's not the case. I don't think it is, but you can't rule it out. So I would say, based on the 3 indices put together, we're about a 2-to-1 favorite that it's going to be just a correction. Maybe you could argue 1 out of 3 that it's going to go into a bear market. CBM. I bought a little CBM and I'm looking to buy a little more. I was waiting for a little lower number today. I think I'll probably get it tomorrow. I'm probably going to be buying a little more CBM. I think it went down more than it should have based on some minor dilution and a capital raise of $8 million the other day. So I know I didn't advertise that I was going to talk about CVM, but I figured, what the hey, I'll pick one biotech that I happen to have my eye on out of 20 or so and just chat a little bit about it, look at the chart just a little bit. So it did not retest a 50% retrace yet. So that's it. I just want to reassure everybody, to the best of my ability, to the best of my mathematical ability, that most likely this is just a correction with an outside chance of about 30% maybe that we will enter bear market territory on the S&P, or at least have an appearance of that based on Elliott wave theory. I wonder what the Elliott wave gurus have to say. I haven't been reading any of their literature. The most famous of them, of course, is Robert Prechter. I don't know what their official forecast is, but hey, you know, he's not the only Elliott wave guru. There's plenty of them all over the internet, and they all say different things. Isn't that interesting? They're all using Elliott wave analysis and come to different conclusions. So what does that say about Elliott wave analysis? It's subject to interpretation, especially in real time. When you look back, you can better understand the Elliott wave structure that just occurred. So this has been Dr. J at 11, coming to you live, streaming live from Long Island, New York, bidding you a better trading day today than yesterday, hoping for nothing more than a correction, which I'm pretty sure. I mean, I can't be certain, but I want to be as reassuring as possible that we're going to turn it around come next week. So I want to say at this point, sayonara, shalom, hasta la vista, arrivederci, ciao.